Everybody, welcome back to another episode of the Growth Capital Podcast. I'm your host, Justin Dixon, and today we've got Omair Sarwar, founder of Gearbox Capital. He's been in the private equity world for about 15 years, worked for an institutional typical PE firm, but then broke out and started his own shop back in 2022. We go through a lot about his kind of career and transitions and kind of what he didn't like about the institutional side of private equity and what he's kind of shifted and changed by starting his own firm. We dig in pretty deeply into kind of the criteria that he looks for in founder-led businesses, above and beyond just the economics. And then we also spend a little bit of time talking about AI and the things that he likes about it and kind of things that none of us really know exactly who's going to be the winner. So very interesting conversation overall. So let's get Omair on the pod. Interested in hearing conversations with private equity leaders, CEOs of private equity-backed companies, and startup entrepreneurs where they share their stories about their career journeys, starting, investing in, and scaling successful businesses, and the important role that having the right talent plays in building a successful business, then you are in the right place. Welcome back to another episode of the Growth Capital Podcast. Here's your host, Justin Dixon. All right, Omair, welcome to the podcast. Happy to have you on, man.
Hey, likewise. Thank you for having me.
Yeah, well, let's jump right in. Give the audience a little bit of an overview of kind of who you are, what you're up to, and where you are also.
Yeah, for sure. I'll start with a little bit of a personal background. So I'm actually an immigrant. So I was born and raised in Pakistan. I fortunate to come to the States when I was 18, and it's kind of like one of those stories where my mom packed my suitcase, gave me $200 in cash, and was like, "Don't call me until you have a job." Right?
Oh, wow.
So I think the long arc of my career is that my mom still takes my calls, but from a professional perspective, I would say for the last 15 plus years, I've been investing in and partnering with founder-led Bootstrap technology companies. And to really help them through, we think of them as kind of some critical inflection points, and have just been really fortunate to have, experienced, partnered with just some wonderful companies, some wonderful founders and operators over the years.
Awesome. And how, when you came over, early in your childhood and even as you're going through school, like, was private equity always the end goal, or was it kind of like you fell into it, or how did that work?
Great question. So I would say no. I mean, I grew up, I would say, quite poor actually. I mean, both my parents were teachers, and
Okay.
there was no financial literacy in my family whatsoever. So I had no clue until I came to the States, and was just really fortunate to get into, I would say, management consulting straight out of college.
Okay.
And as much for just, I needed a visa to stay in the States than anything else, and they would sponsor you. But
Yeah.
it was a wonderful early education, and I just so happened to get put on a number of these cases for other private equity firms, and it was just like a aha moment went off. I was like, wait. So in the U.S., in this magical land of opportunity, you can borrow money from someone, buy something, use the cash flow of that something to pay off the money, and it's all yours. Like, this is just magic. And so I was hooked. I was like, I have to do that. I have to be a part of that. Now, that's a very simplistic view of what we do, but that's kind of the light bulb kind of went on back in 2007, 2008.
Got it. And so obviously 2007, 2008, start of the, financial crisis and all that stuff. How did getting into private equity at that time, I guess, drive your thought process maybe even now? Like, obviously getting in a kind of scarcity mindset in that time frame, like how did that shape your kind of outlook?
Yeah, very much so. I mean, and I think any investor that tells you otherwise is probably, I think there's they're not being either transparent or not fully aware, because I mean it's like PTSD in some ways, right? So it influences your thinking, and I would say it influenced my approach in a couple of ways. One, we're tend to be a bit more conservative on leverage relative to some of our other private equity peers, just because I saw what that led to. And then the other thing was more of an appreciation for psychology, which was, and we can get into it, to the current environment, which was I just noticed that it takes particularly founders and these smaller family-owned businesses, they tend to lag the public markets in terms of valuation expectations, in terms of psychology, by like something like 18 to 24 months. Right, and so in some ways it was also a realization that, hey, we're going through this tough period right now. There's all the news about these public companies, and in about 18 to 24 months, when the dust settles, there's going to be a lot of interesting opportunities, right? And so almost like a patience element to it. But yeah, I mean, and so now, I've gone through like three cycles now, I would say, from an economic and perspective, and it's, some things never change.
Yeah, and I guess jumping into the current environment, obviously you've been investing in private equity or in the private equity world for, like you said, a few different economic inflection points with 08 and 09, and then obviously COVID, and we're kind of coming out of that. So, like, what have you seen over the last few years? And obviously you started Gearbox, a few years ago, right, in 2022 officially, I think. And so maybe starting in kind of 2020 and forward, like how has kind of you working at a other private equity firm and doing deals, as part of an ecosystem, and then jumping out in 22 to kind of do your own thing? Yeah,
and it's somewhat intertwined. I would say, my prior firm, where I was for almost a decade, right? I mean, I would say I came into my own as a partner, as a leader, kind of in the middle of the bull run, right? I would say kind of in that 2015, 2016 time period. And so we were able to kind of see this whole, good businesses at, reasonable valuations, like people that had, good values, were looking for partners, et cetera. And then kind of over the next 5 years leading into 2020, we just saw psychology changed significantly. Some combination of, I think, capital and technology and just general psychology. And so 2020 was a big just wake-up call, honestly. I mean, I would say in retrospect, we're fortunate that we put things on pause right around then, because we saw just, valuations were getting out of hand. And it's less about valuations, I would say, because our philosophy is more, we're looking for good businesses at fair prices. It's not, we're no longer in, the private equity land and we're trying to get steals and we're trying to, bargain basement or anything like that. But it was more, I would say, valuation tied to the expectations that people were putting on these businesses. And what I found is, that's almost worse, right? Where a founder or a company or a management team is saying, this world is going to continue. We're going to grow at 50% year over year for a decade, and then we're going to set up our cost structure and invest, assuming that's true. And a year later, you're just going to be sideways, right? And so it was almost less about valuations, more just what people's growth at all costs kind of mindset was that just made us say, hold on.
Yeah, it's definitely interesting seeing what everything was going on in 2021 and crazy valuations, and now all of these, there already were kind of these conservative, thoughtful growth private equity firms out there that were kind of almost in the minority, I think, and everybody was chasing these unicorns. But now even the grow at all cost private equity and VC shops are starting to change their tune of like, no, we're conservative. But I almost wonder how long that will last, because if things start to go back to, interest rates start to drop again, when will they start increasing their valuations? And I guess going back to your kind of criteria for Gearbox, like what is the ideal company or ideal kind of framework and industries that you kind of target?
Yeah, I would say from I think framework is the right way to think about it, right? I mean, there's no kind of hard and fast rules in our world, but the way I've kind of communicated to my team, the way I kind of speak to our LPs is we're really looking for opportunities kind of at the intersection of three circles, if you can imagine like a Venn diagram, right?
Yep.
The first is, and probably, and they're all kind of equally important, but the first is kind of the situation. What do I mean by that? It's typically a founder that's bootstrapped a business that has kind of a responsible growth mindset.
Yep.
And somebody that, they care about their product, they care about their business, they care about their people, right? And so there's a values component to it.
Yep.
And the older I get, right, the values start to matter more. And I realize they genuinely, they matter more. And so it's kind of the right founder with the right values that is oriented towards partnership and finding a true partner. And what it takes to get there is typically an opportunity to cultivate this relationship with them over a longer period of time, right?
Yeah.
What I wanted to get out of, which was at my prior firm, which is common for a lot of private equity funds, is kind of this speed dating trap of like, you got to meet somebody, you got to make a diligence decision, and you have to close within 3 months. And I just find that that leads to just a lot of missteps. And so to me, it's kind of being able to cultivate these relationships. I think it works both ways, honestly. I mean, if I were to advise founders, I would say the same thing, which is, hey, over a 12 to 18 month period, we get to see how a founder operates, how a team operates. We can see their values in practice. Do they take advice well from a strategic partner? And at the same time, they get to evaluate us, right? In terms of what our values are. Is our support and expertise real, or is it just feigned? When we say we have operational resources, do they really exist? And so I think it works both ways. So that's super important to us, the situation. The second circle, if you will, is kind of the business itself, right? And there we're looking for a product or a service where the value proposition is really compelling to the point where you can either quantify it, or as I like to say, I can explain it to a middle schooler and they'll get it,
Yeah.
And so that's really, we're very bottoms up, kind of fundamentals oriented that way. And then the second thing we're typically looking for about the business is, okay, what moats do they have, right? Okay. Is it a technological differentiation that is sustainable, right? I would say, for example, AI foundational models, right? What we're learning is the technological differentiation may not be sustainable. It's just, who has the biggest pocketbook and who can, buy more NVIDIA GPUs.
Right.
But that's one piece we look for. The other is kind of, do they have some kind of differential market position, either because they have great customer base, or they have they kind of figured out this niche, right, where they're kind of the large fish in a small pond. And the last piece, which we find in software often, is there something distinctive about their go-to-market? Because for a lot of software, there's over time, anybody can build the software, right? The software itself is typically not, with the exception of some very specialized technologies, it's not long-term differentiable. So the go-to-market is something that we really, to us, if we can find and we can diligence the unit economics of the go-to-market, and within that, we have an affinity for what I think of as kind of higher velocity go-to-market models, like product-led growth companies, because we have a lot of playbooks that can attack that well. So that's kind of the second piece. So we have the situation, we have the business. Yep. And the last thing we're looking for is, does this opportunity have what I call multiple ways to win, right? I mean, if you play poker, are the odds in your favor? And what that means for us is typically that we can identify 7 to 9 kind of discrete paths to create significant value above and beyond the status quo, right? What I tell my LPs is, look, if a business is growing 20%, right, and anybody kind of acquires it and it continues to grow 20%, did they really add something significant to it? And so what we're trying to do is find paths to augment or accelerate the business trajectory. And so for us, that comes into play using what we call kind of our pulleys and gears framework, which is really identifying the right pulleys. So a pulley would be kind of a pillar, right? Okay. Which is kind of the core strategic vector for the business. And so let's say a product expansion is a core strategic vector. We've identified it. And then what are the gears, right? Which are more the plays and the tactics that we can execute in the near to medium term. And so that would be, hey, we've identified this opportunity to create the specific functionality that we can monetize really well. Or it could be, hey, we've identified this opportunity to optimize kind of the onboarding flow of this product that can drive up our conversion rates. So those would be gears. And so we are trying to find situations where our playbooks, our resources can attack like very specific opportunities. And not every business needs us, right? I mean, that's the other thing. And so, and that's totally fine. And so we're looking for the intersection of these three areas, and when we find it, like it's it's like magic.
Yeah.
It's wonderful.
Have you seen recent, like over the last year or two, valuations of what the founders, these Bootstrap founders, are looking for? Has that delta between what you think the value of the business is and what they think it is, has that come down a little bit? Because I know it's been pretty wide.
It's narrowed significantly. Okay. I would say more than a few. And so, examples of folks and great founders, good businesses, where in 2021 they had valuation expectations that were, call it, 7x, 8x, 10x ARR.
Yep. And
look, I mean, I do in some ways. I feel for them. I empathize, because they, but they didn't sell.
Right.
And so now, 2 years later, they're like, yeah, my business is more like 3.5, 4x ARR. I mean, so think about that. That is a psychological.
Oh yeah.
Right.
I should have. Could have, should have. It's like.
Well, but think about. Genuinely, and this is why it takes. Psychology is so important. This is why it takes 2 years, because imagine 1 year. Somebody's telling you that your business is $100 million, although it has 10 million in ARR, right?
Yep.
It's a 10x, and you own, call it whatever. Let's say you own 100% of it. Now 2 years later, yeah, you've grown. So let's say it's 15 million in ARR, but it's 4x. $40 million are suddenly gone. You feel poorer, and so. Right. A lot of it is finding those folks that are kind of level-headed and they genuinely want to partner and they realize where they are and they're oriented to, okay, but then now how can we work together to get to that 100 million in enterprise value down the line, right?
And it seems like your kind of proposition to a founder, and correct me if I didn't hear this right, but your proposition is maybe less of a 3 to 5 year hold, kind of a typical PE flip. You're thinking about it more of a partnership of, obviously you're going to be taking a certain amount of equity, whether that's majority stake or not, but you're coming in as more of a strategic partner for them over the long term versus, hey, I'm going to come in and buy your business, flip it in 5 years. Yeah. I'm going to return capital to my LPs and go find the next one. Is that kind of a very simplified version of some value that you kind of differentiate?
Yeah, 100%. Because I would say, that was part of the reason why I left and started Gearbox was, I saw this gap in the market between kind of these businesses that were between kind of the VC growth at all costs mindset and kind of the transactional, impersonal private equity mindset. And so kind of the path in between is this, I would say I would call them cultivated partnerships.
Yeah.
Right. And the way we don't talk about time horizons with our founding partners. We talk about the mission. What is the mission, right? And sometimes the mission is tied to, hey, we've identified these 7 paths, right? How many of these paths can we walk down? And if we walk down 5 or 6 and we're like, you know what, we can't identify another 5 to 6, then it may be time to monetize, right? If we kind of have walked these 5 or 6 paths and we're like, oh my God, those 5 or 6 paths have now branched out into another 5 or 6. Yeah, let's go.
Got it. And then your LPs are kind of along the ride for that journey, right? Because a lot of, some of the LPs, and we're seeing some of the other private equity I talk to, like they have deals on their books, so to speak, that are past that 5-year horizon where they're also in that position where maybe they should have sold in 21 and they didn't.
Yeah.
And now they're like, well, what do I do? Do I reinvest in this company to get it to back to that valuation that we thought it was, or do I exit now, get at least return capital back to the LPs and then go live to fight another day? Like, yeah. I guess that's kind of also an interesting dynamic that's going on right now.
100%. And look, I mean, I came from that institutional investment background, right?
Yeah.
And I would tell you, I think a lot of private equity firms that were very active and deployed a lot of capital in that 2019 through 2021, 22 timeframe, I think they're afraid.
Yeah.
They're afraid. And inaction is, it's a way of kind of dealing with, your fear and insecurity, because, it's a rock and a hard place. It's a rock and a hard place. And I'm hearing more and more about, scenarios like that. And again, I empathize with these people, right? I empathize with the management teams, their equity's underwater. I empathize with, the private equity groups. They haven't marked it down, but they kind of know their equity's underwater. And it's a tough place.
Is that a buying opportunity for you? Do you see that as like, hey, there could be some of these, low-hanging fruit / deals, if you will, or is it not that black and white?
Yeah, I would say for us, it is a very interesting time, but it's less. Again, we're not trying to capitalize on other people's pain, right? I mean, that's not so. We're less interested in kind of, getting something at a discount from a private equity firm and yay, we won, right? It's not a zero-sum game for us. And so the reason I think it's an interesting time for us is because I would say there's more companies out there, more founders, and some VCs where, expectations, and reality are starting to now meet. And so it is more possible to do what I would say, meet on fair terms, right?
Yep.
Because I think I don't want to start a journey with somebody. I mean, these are like marriages, right? I don't want to start a marriage where it's like, oh, I've taken advantage of you. Like that's just, life is too short, And so, so we don't come at it that way. We come at it like, there's good businesses where we can add value that are now kind of at reasonable expectations, and we can have a fair exchange.
Got it. When you do your due diligence of these companies, and it sounds like your diligence process may be a little bit longer than the typical institutional PE firm, coming at it from a talent perspective, like how do you look at obviously the financials of the business, but then the talent that exists in that business that maybe, if you've identified those 5-7 paths of kind of success, do you look at the talent internally in the company and say, okay, this is a company that we can just lean on the management team and their teams below them to get us to those paths? Or do you also look at it like, okay, we need to now change out these 2 strategic places, these positions, and then go find those things? Because that's always like, the financials have to look good, but then the talent has to be there and in the right seats, obviously, too.
Yeah, for sure. I would say from a diligence and evaluation perspective, right? One is kind of like diligencing the core business, right? And that, you can do reasonably well, especially if you have domain expertise in the underlying sector, yada. I would say what's I would argue almost impossible to do in a kind of a banked process and an auction process, for example, is diligence the team, diligence the founder. And so that's where, we take a longer time. And so it's not like a formal diligence. I mean, it's genuinely in the interest of understanding values, understanding capabilities towards a partnership, right? Yep. And so an example of that would be, hey, we will, once we've understood a business, understood the market, we'll go sit down with the founder and his team, whatever may exist at that time, and we will present our plan. I mean, and it's, some of my PE peers look at me and are like, dude, that's free consulting. What are you doing, right? So we will go and present our kind of pulleys and gears framework for what we think is right for their business. And that will lead to a kind of engaged debate and collaboration. And oftentimes out of that, yeah, sometimes, a founder may say, oh, thanks for the free advice, and off we go. But, more often than not, people are like, actions are execution is much harder than any ideas, right? And so, but what it allows us to do is build alignment and collaboration well in advance of kind of a transaction process. And so when we kind of actually, let's say, close, people are already aligned and ready to go, and through that process, we then, yes, part of it is evaluation of the team. Part of it is an evaluation of any gaps that may or may not exist against the plan that we have. And so that's kind of how we approach it. Now, over my career, have I been in situations where the founders were like, we want to retire? There's nobody here. Here are the keys.
Right.
And we had to build the entire management team from, the full C-suite to what I would say is probably a bit more normal, where there's a great founder. He may have a head of engineering. They may have kind of a marketing guy, but they don't have sales or they don't have customer success, and so we're kind of filling in the gaps.
Yeah.
Across what I would say foundationally, what is happening more and more across all our portfolio companies is what I call kind of the implementation of the Gearbox operating system, which is more kind of around standards and processes of how teams will interact, how people will hold each other accountable, kind of, et cetera. And so that is, and that's not easy, but that's kind of that happens consistently now across the company.
Yeah, and if you have that operating system, you can kind of, and it's proven, right? You can go in and say, hey, we've implemented this in another company, and this is what the success looks like. So, it just breeds more success if it kind of is more standardized as opposed to being super custom for each individual company, I would imagine.
Yeah,
so,
for sure.
And I guess a question on the founders part is, are you seeing a lot of founders that they want to stay in the business, or like proportionally, or do they want to get their money and then get their check and go sit more on the board and maybe be an advisor, but they still have 10-20% or whatever it is?
Yeah, and so typically we will look for alignment towards folks that are very vested, both emotionally and financially, in the success of their company. Because the second bite of the apple, if we achieve the plan, they're going to make so much more on that second exit than they are on whatever happens today.
Yeah.
And so we're flexible, right, in terms of does the founder want to kind of just ride off into the sunset or sit on the board, or or stay involved, and both scenarios require some different testing, right? So if the founder wants to retire and is wants to just be a board member, an advisor, then we're in some ways testing for how much do they care, right? Are they truly like this was just a transaction for them, or are they still vested in their people, their customers, genuinely interested in kind of the success of their business? And if they want to stay involved, then we're testing slightly differently around, things like, humility. Are they willing to take coaching, right? Because oftentimes for these founders, right, they're kind of going from in the weeds to now managing through data, through scaling. And so some coaching and mentoring is important there. And so we're kind of gauging for both scenarios, kind of different things.
Got it. I want to shift a little bit to a more kind of hotter topic, kind of on the AI front.
Sure.
Everybody is putting AI either in the title of their business or it's in their business somehow, and it may just be a little Chat GPT plugin. But I guess, how are you sifting through the noise? Because everybody is putting AI in there. And also, a second kind of follow-up, are you looking for AI companies right now?
I would say we are not. And part of the reason is One, we're not venture capitalists, right? So we're not taking this massive portfolio approach to our investments. And the reality is, I can't tell who the winner is going to be, right? And so, because frankly, there's just no proof points, and so we're just kind of different from if I was a VC, I can definitely see that it makes sense to, we'll invest in 10, and even if one of them kind of is successful, it's all good. But we take a very different approach. The way we think about AI is more from a defensibility perspective. What I mean by that is, are we looking at a product or a service? What are the risks that AI may disintermediate that in some way? And so we're coming at it slightly differently. And then, of course, with our companies, we're saying, okay, on the margin, where can we leverage AI to either improve the product, improve our service, et cetera, et cetera. But I would say, completely transformative, like 100% can't doubt. It's like the internet all over again, right?
Yeah.
But also like the internet all over again, we don't really know who the winners are going to be. And so, yeah.
And have you done any implementation of AI into your business or your processes to help you analyze faster or anything like that?
Very much so. I mean, so we are constantly utilizing, I would say now, more and more kind of AI tools for specific functions. But it's very interesting. I find it, a lot of the applications right now are much more productivity and efficiency driven. And so less that they're transforming our product in some way, right? It's more our sales team or support team is using them to, essentially, in some ways, again, it's drive productivity and, less manual effort and thus less employees required. So that's how we're thinking about it currently. Over time, could it change to, more embedded AI in our products? Yeah, it could.
Got it. Well, as we wind down here, I want to kind of shift to the future. I guess, what are you looking forward to? What are you thinking, will happen? Obviously, we're recording this, the back half of 24, so we've got an election coming up, so a lot of things can change depending on how that goes. But I guess, if you think about kind of what could happen, the next 12 months, what are you thinking are kind of opportunities and maybe some potholes to look out for?
Yeah, I would say, look, the opportunities are, as we touched upon, I think there's a lot of, interesting businesses that, I would say their expectations have kind of shifted towards finding a good partner, reasonable terms. And I think that, there's a bit more humility that's kind of been affected across particularly the tech ecosystem. And that's really exciting to me because, again, what do I love to do? Find great founders that want to partner and, find businesses that we can help make better. And so I think that opportunity has increased for sure. On the other side, where AI is going to go, I have no idea. I'm just not going to play that game. The only other thing that I would be very interested in, I don't know the answer to this, but my assumption is as interest rates go down, do we return to the go-go days of the mid to late teens? I don't know. I hope not, but I just don't know, right? As interest rates go down, money becomes easier, cheaper, more capital again. Do we go to like the irrational exuberance? Maybe.
Got it. Yeah, it's there's a lot of things that we don't know, and it's only one of the things we just gotta wait and see kind of how it all shakes out. So this has been a lot of fun. I want to end this with the 3-pack of questions I ask every guest. That's a little bit different than the business heavy conversation we've had. So first question here is, what is your favorite business book?
That's a good one. So it's actually what my firm is named after is a concept in high output management by Andy Grove, who is the father of OKRs, if you will, at Intel. And so
Got it.
Gearbox is actually a concept that came out of the book. So yeah, definitely that one.
Very cool. Haven't heard about that one. I will check it out though. All right. Second question is, what is your favorite thing to do away from work?
Oh man, you see that surfboard behind me? When I can find, when I can find the time.
So.
Yeah, yeah.
Very cool. And this may tie into what you just mentioned, but your favorite vacation spot?
Ooh, definitely any place with good waves.
Okay. Yeah, I figured it would be tied very closely.
Yeah.
Well, this is awesome, Omair. What if people want to kind of learn more about Gearbox? Maybe reach out to you just to learn more about what you're up to. What's the best way for them to reach out and connect?
For sure. So I would say point them to a couple of areas. One is just our website, www.gearboxcap.com. I'm available, on LinkedIn, pretty easy to find, and always welcome to hear from people. Always welcome to collaborate and share ideas. And yeah, we'd love to hear from them.
Awesome, Omair. Really appreciate the time, and this has been a lot of fun.
Awesome, man. Likewise. Thank you so much.
I hope you found at least one actionable insight from this episode of the Growth Capital Podcast, your one-stop shop for insights from private equity leaders, CEOs, and startup entrepreneurs on starting, investing in, and scaling successful businesses, as well as the role having the right talent plays in growing a successful business. It would be greatly appreciated if you would rate and review this podcast. And if you're watching on YouTube, please like and subscribe and drop us a comment so we can expand the audience of this podcast. Thank you for all your support, and don't forget about upcoming episodes dropping every Tuesday.